Hello.
Hello, hi, how are you?
I'm fine, thanks. And you?
Yes, I'm very good, thank you.
Okay.
Any questions you have before we continue with the lesson?
Uh, 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 uh,
Mhm.
Not yet.
Okay,
Not yet.
right.
Everything is
Yeah,
more or
okay,
less okay.
right. So today I think I'm going to finish up the long-term finance, and after that what I'm going to do is I'm going to send you some questions which you will try, and then we will get together and do it.
Okay, no problem.
Okay, so we were looking at the rights issue. Remember rights issue, what is it? It is shares offered to the existing shareholders at a discounted price, a price less than the market price, and we saw with little bit of calculations, it is not going to increase the shareholder wealth immediately because you have to pay some money out of your pocket to buy the shares, and what we saw was the share price when the moment the rights issue is announced, the share price drops due to uncertainty, and then again it drops after the rights issue because there are more shares in the market, because there is dilution of earnings per share, and also you came at a lower price than the market, so therefore it drops further, and that drop or that new price we call it X theoretical price or theoretically X rights price. We call it TERP, theoretical X rights price. That is after the rights issue, excluding the rights issue, the price is called TERP. So we did a little calculation last time. So I'm going to look at that one again. So market price after the rights issue. Today, once they announce the rights issue, it will drop. That is due to the uncertainty about the project and all that. Then the company will give about 2 weeks time for people to subscribe for rights, and once it is done, it will drop further, and that is because of the number of shares in issue has gone up, and also the shares are issued at a different price from the market or lower than the market price, and therefore it will fall again, and that price is what we call the rights, the theoretical exercise price. So we did a little calculation last time, so I'm going to look at a little calculation again. Let's assume you have 3 shares already. Presently you are holding 3 shares. 3 shares just before the rights, that is what we call cum rights price, cumulative of rights, that is the last day before the rights are issued. Let's assume it is 11. 11 into 3 shares you had at this moment of time, the value is $33 because the price is 11 just before the rights. And let's assume that they are issuing one new right. For every 3 shares, they are issuing one new right. Let's assume they are issuing it at 9. So now, altogether, you have 4 shares. What's the total value? Earlier, the 33 was the value, and you paid a 9. So there are 4 shares worth 42. So from here we can see per the new share after the rights issue, the theoretical exercise price is 42 divided by 4, which works out to 1050. So you can see what happened. It was just before the issue, it was 11. The new share was issued at 9, and it has got settled down to a price between 9 and 11, and it should be 1050. As I said, this is the theoretically, mathematically calculated thing. The actual share price may differ, but the theoretical strike price is 1050. So what we realized was, yeah,
30 or the price of 11 is
the price
after
at 11 is just before the rights issue.
Yeah, but it is after the company announced the
After
right
the
issue.
company announced, when the company announced, it may have been 12, but just before the rights issue, just the company gives you about 2 weeks time or 3 weeks time. The last day, just before the rights issue, it was 11.
That means that this price is X rice price.
No, this is cum rights price, just before the issue. Just before the issue.
Cum rights
Cum
is
rights.
before the issue,
Yeah.
not before. It is before the issue, not before the announcement.
No, after the announcement, before the issue. Today they announce it.
Okay, is what I mean.
Yeah.
Is after the announcement, but
Before the issue. Before the issue.
But before, the question is, when a company announces a right issue, the period begin to go immediately or not, or you
gradually it will come down. Say it would have been 12 at that time. Next day it will come down to 1175, 1160, like that. It will come down till maybe 11. I'm taking some estimated figures. It will come down from the, say today is 27. When they announced it on the 27th, the price was 12. But they gave time till 4th of November or 10th of November for the people to buy. By that time, between 27th and 10th November, the price will start coming down due to uncertainty of the new project. And by the 10th, just before the rights is given to you, the existing shareholder, the price has dropped to 11. That's what I mean.
Yeah, but my question is, when the company announced a right issue, does the do the shareholder have time to think about that? I mean, if you are telling me that normally you have 2 weeks time to decide it.
2 to 3 weeks time will be given.
Okay, but this period begin in the right moment that the company announced the right issue or not?
Yeah. So today if they announce it to the stock exchange saying that the existing shareholders will get for every 3 shares 1 new share at 9, from that day onwards automatically the stock market reacts.
Okay. Yeah. That means that in the moment that the company announced the right issue, the price dropped to 11.
Price dropped to 11 slowly. It will not drop tomorrow morning to 11. Tomorrow morning it may come down to 1175, 1150, so on and so forth. But just before the 10th or the 15th of November, it will be 11.
Okay. That in that case, the cum right price is the price just before
the last day before the rights are given.
Okay.
That's what we call the cum rights price. So that price I thought it to be 11. And you will get a new share. Now, if you look at that 14th of November, the last day, the wealth of you was 33. Because it was 36, but it had come down. And the wealth of yours was 33 just before the rights were issued. So you have 33. And you bought a new share for 9. And now your total wealth is 42. 42 because in shares you have 42. But as I said, to make it 42, out of your pocket you spent $9. And therefore, if you really look at the net wealth is same $33. Just before the issue, it was 33. And even after the issue, the wealth is, although in shares 42, from your bank balance, $9 have gone off. So your net wealth, 42 in shares, $9 less in the cash balance, it will be 33 still. And that 42, you have not 3 shares now, you have 4 shares, and because of that 42 divided by 4 will be the new rights price, new share price, which is 1050. This is what we call theoretical rights price. TERP, theoretical ex-rights price. So this is one way for us to calculate the TERP. How do? We look at the number of existing shares, multiply that by the cum rights price, see the number of new shares that is issued by the issue price, take the total amount, divide it by the total number of shares, you can get that price 1050. So that's one way to calculate it. Then we have another formula. So I'm going to put the formula here now. Examiner will give you the formula. You don't need to memorize the formula. But I'm going to put the formula here. So as I said, when the right is announced, all existing shareholders will have the right to buy new shares, and thus there are rights, cum rights, attached to the shares, and they are traded at cum rights price. So from the 27th of November till the 14th, from 27th of October till 14th of November, it will be traded at what we call cum right price. It will vary, but the final night price is the ultimate cum rights price. On the first day of dealings in the newly issued shares, that is the 14th, is the closing date of the rights. After that, if you either you have bought it or you have not bought it. But on the 15th, you have no rights. Already either you have got the rights, or if you are not applied, you will not get any rights. And so no longer exists, and old shares and new shares are all traded at X rights price. So after that 14, you don't have old shares going at 11, new shares going at 950. No, all the shares will go at 1050, the theoretical X rights price. So that's what we saw. So remember the figures, 3 into 11. 1 came at 42, divided by 4, X rights price is 1050. Now, the same thing you can calculate it through a formula. So the formula to calculate the theoretical X rights price, N times cum rights price plus issue price divided by N plus 1. So what is this N? N is number of rights required to buy one share, or number of shares required to buy one share. So how many, now in this particular situation, how many rights you had to have it to get that one extra share? How many shares you had to have it to get that extra one share? So we had to have, in this particular situation, the example what I'm working, we have had to have 3 shares. So N is 3. N is 3. Right? That is, to get the extra one share at a concessional rate, I should have had 3 shares, and that is what I call N. What are the cum rights price? The last day price, which is 11. Plus issue price. Issue price is the new price of the rights, which is 9. Divided by N plus 1. N is 3, plus 1 is 4. So you can see you will get the same answer. 3 into 11 plus 9 divided by 4, you will get the 1050 answer. So through the formula, you can get it like this. Or the way that I did, was I looked at 11, you have 3 shares at 11, 1 share at 9, 42 divided by 4, I got the same answer 1050 without using the formula. But sometimes the examiner says use the formula. In that case, he will give the formula. you have to remember that N is always the number of shares that you have to have to get that one extra share. So if you had 3 shares, you will get 1 share. So 3 into 11 plus the 9, the issue price of the new share, divided by N plus 1 will give you the rights. Is it clear?
It is.
Yes. Now I want you to understand something. Look at what happened. You being a shareholder, right? You being a shareholder, you had the privilege or the blessing to get 1 share at $9. And that 1 share is now trading at $10.50, right? So you being an existing shareholder, you managed to get 1 share extra, and that 1 share you paid only $9, but that is trading at $10.50. Now that is what I call the value of right, the blessing you got, the privilege you got. The market is going to be $10.50, but you had the opportunity to buy it at $9. So you can see there is a value that is coming up. But now that value, so what is the value of that share? The value, it is the new share price, the theoretical exercise price is $10.50. You managed to get it at 9. So there is a benefit of $150 per new share, or the new share, the benefit is $150. So you got a benefit of $150 for the new share. But examiner might put up the question in different ways. One way is to ask this is what I call the value of right. Value of right per the new share, it is $150. But if you look at the value of right for existing shares, to get this $150 benefit, you have to have how many shares? You have to have 3 shares. The value of right per existing share, just because you had 3 shares, you managed to get a benefit of $150. Because you managed to pay $9 and buy a share which is worth $10.50 next day in the market. So to get that $150 benefit, you had to have 3 existing shares. So the benefit or the value of right per existing share is 50 cents. Value of right of the new share is $150. So I'm making it very strongly 2 things. Value of right of the existing for the new share, it is $10.50 minus 9, $150. You have the blessing of getting 1 share which is worth $10.50 tomorrow morning, but you paid 9 and that means a $150 benefit. But to get that $150 benefit, you have to have 3 shares. So per existing share, the value of the right is 50 cents. 150 divided by 3. So that also you can work through the formula. So I'm putting the same number, same example I'm working. So you saw value per existing, value of right per new share is 150. Value of right per existing share is 50 cents. You have to have 150 benefit, but you have to have 3 shares. So now I'm putting up on the right side value of rights. Value of right is theoretical exercise price, which is $10.50, minus issue price at 9, divided by N. N is the same in here. The number of shares you have to get that 1 extra share, in this case 3. So value of rights per existing share, it is $10.50 minus 9, $150 divided by 3, which is called a 50 cents benefit. So you can see, by subscribing for that extra 1 share, your present shares, the 3 shares, brought a benefit of 150 for you. And if you really divide it by the 3 shares, per share, you had a benefit of 50 cents. You paid $9, but you have got a share worth 1050, and that 1050, to have that 150, you have to have 3 shares. So per existing share, it is 50 cents. So what happens if you don't subscribe for the rights? Still, whether you subscribe or not, the share price will drop to 1050. But you did not subscribe, so you did not get a benefit. So if you don't have money, if you don't subscribe, that is what is going to happen. Finally, what will happen? You will have only 3 shares worth 1050 into 3, 3150. Originally, it was 11 into 3, 33. But you did not have money to buy that extra 1 share, so you did not get the value of right or the benefit or the blessing. So now you did not buy it, some other person would have bought it. So because some other person had bought it, the share price came down to 1050. So your wealth has come down to 3150. So you can see exactly what happened. If you don't buy that value of right, that 150, your wealth will come down. So this is very important for you to understand. When you don't buy the rights, the company will offer, you don't have money or whatever the reasons you don't buy it, and then what happens is your wealth, which was 33, now will have come down to 3150. If you have
you haven't.
Yeah.
But you haven't considered in the first case that the rest of your share, the price of the rest of your share are dropped.
Yes.
As well.
Yes.
And that means that, okay, your value of rights is gonna be 0.50.
Yeah.
But
yes.
The value of your existing shares are minus. Is minus.
Yeah, but whether
it's the same case.
Yeah.
I mean, at the end. At the end, if you do the same calculation as you are doing now, with if you don't execute your right, at the end you are gonna be in the same position, because on one hand you are gonna win 1.50 because of the value of rights, but on the other hand you are gonna lose 1.50 in your existing shares.
Yes.
I don't know if I'm explain very well myself, but you know what I mean.
Now look at what is happening. Whether you bought the shares or not, at the end of the 14th of November, the share price will drop to 1050.
Yes.
Right? Because if you do not buy it, the company will offer that right to another person. They offered it to you, you did not buy it, the company will offer that right to me. So whether you buy it or not, or the underwriter will buy it, the price will come down to 1050. Right?
Yeah, I understand that.
Right.
But what I'm trying to say is,
okay,
imagine that you buy the rights, the new share, the rights issue.
Okay.
You buy it, and according with our calculation, you are gonna win in total for the 3 shares. You are gonna win 1.50.
Yes.
Okay.
Yes.
We agree on that. Okay.
Yeah.
But on the other hand, your 11 previous shares, the price are going down.
Yes.
And you are gonna lose 1.50.
Yes. So that is what I said earlier. The issue of rights is not going to increase your wealth. But
okay, perfect.
Right now, but the moment you don't buy, you lose that 150.
Okay, perfect.
Yeah.
That is about the same.
Yeah, that is what is going to happen. Actually, there is no gain for you, but when you don't buy, you lose that 150. So you are down.
Okay, that means that you have 2 options.
Yeah.
One option, buy the right issue, and your wealth
will remain intact.
Yeah. Or another option is Not to buy.
Not to buy, you lose it. Hello? Hello, hello? Hello, hello, hello? Hello, hello?
Hello, now.
Yeah, yeah, I think there was some problem in the connection. I think it's all right now. Right.
Yeah, I think so.
Yeah, right. So what I said was, if you don't take, you lose your wealth. If you take, you can maintain your wealth at the original position.
Perfect. We agree.
Right. Yes. So that's agreed. Right. So that's what we call the value of right. 150 is the value of right. So you can calculate it either through the normal way or you can calculate it through this formula.
Okay.
Okay. Now we are going to look at the implications of a rights issue. When a company comes out with a rights issue, what are the implications? So after issue, what is going to happen? So let's see from the company's point of, or from the shareholders' point of view, right? When the company announces a right issue, the shareholders have the option to buy shares at a preferential price. When the market price is 11, they can buy it at 9. They have the option of withdrawing cash by selling the rights. I'll come to that in a minute. That benefit what we have, we can sell it to another person, but that I will discuss it to you in a minute with the numbers. Also, they can, because by buying the shares, you remember what happened was, they will maintain their relative voting position. If you don't buy the rights, you will lose your preemption rights and you will lose your voting position. Because when the company...
Okay. Okay.
Yeah.
Okay.
Yeah. When the company, the shares goes up, when the company number of shares goes up, when you also go up by the same proportion, that is if you buy the rights, you will maintain the same status quo. But when the company shares goes up and if you don't buy the rights, and if another person buys your rights, your value or your interest in the company will come down, it will get diluted. So those are the implications of a rights issue from the shareholders' point of view. The second point, I will discuss to it in a minute. But from the company's point of view, what are the implications? Simple, cheap to implement it. Rather than going to the entire market, you just keep the existing shareholders informed through the share market and they will buy, and that's much more easy and cheaper way to get money rather than going to the main market and asking all the people. Usually it gets subscribed because the existing shareholders know your company very well. They know unless you are really doing very bad, generally the people will trust you, will buy the shares. And also, the moment you come out with the rights issue, that means your company is growing. You are looking for some new money for expansion. And that itself is a good thing, and that is going to give some good publicity for the company. The people will feel, oh, your company, this company is growing. Because if you are not coming out at the rights issue and asking for money and all that, that means you are stagnant, you are not doing better, you are just there. But the moment you come out with rights issue and say we are going to venture into a project in Bangladesh, we are going to venture into a project in Vietnam or whatever it may be, that is going to give a lot of publicity. So these are the implications of a rights issue from a shareholder's point of view and from a the company's point of view. So now we talk about little bit about a debt finance. What is debt finance? So debt finance, share money is the money that the owners or the shareholders will give to the company. What is debt finance? Debt finance is the loan funds to a business without conferring owners' rights. So you don't give ownership rights. You say you have money, you go and buy not the shares of a company, but you go and buy bonds of a company or debentures of a company. And when you buy, you will get interest, you will not get profit. You can't vote, so you don't have any voting rights, you don't have any controlling rights, but you will have something called debt finance, and you will be guaranteed that you will get the interest. So for it to be defined as a debt finance, it has to be an arm's length transaction. So if a director gives money to a company as a loan, it's not an arm's length transaction because it is the director is not director is part of the company, and if he gives a loan, that's not debt finance, that's a director's loan because it's not an arm's length transaction. The return is paid in form of interest. Interest paid is paid out of yeah.
So, sorry, could you say it again, please?
What is that?
I mean, could you say it again, please?
The director's part.
No, the. I think that from the beginning, what is debt finance and the difference between debt finance and the direct.
Equity, yeah, okay. So we know.
Not equity. Okay. Equity, I know that.
Right, okay. The difference. It's a loan and so now the company needs money. Company goes to a bank. And bank gives a loan. When a bank gives a loan, it is called an arm's length transaction because it's relatively to distantly related parties. I mean, they are not relations. The bank is in business. You want money and the bank gives you a loan, and bank will charge the commercial rate of interest, and that is called debt finance. You are a complete outsider. The company announces a debenture issue to the stock exchange. You go and buy shares, debentures, not shares, debentures. That is also a transaction between the company and a relatively unknown party. You are not giving money because you love the company. You are giving money because you want to get some interest as a return. And that kind of outsider's investment into company as lending is called debt finance. But sometimes so happens the company is going to a very difficult period. One of the directors might give an additional loan to the company for a shorter period. That is not debt finance. That is not considered debt finance because it is not an arm's length transaction. It is not given at commercial rate of interest. It is given because the company.
Sorry, Kumar. How do you call that?
That's a director's loan. Director's loan.
No, okay, but you say this is not.
It is not under debt finance.
Yeah. Okay.
It cannot be categorized under debt finance. It must be shown separately as a loan given by the director because they are called related party transactions. Related parties. So they have to be shown separately in the statement of financial position, because sometimes they might charge lower rates of interest, or sometimes even they might charge higher rates of interest. So the shareholders must know when a director gives a loan to the company, how much did he charge? If the other people are charging 7% and if he charges 9%, that means he has misused the position as a director to give a company a loan at a higher rate. Sometimes the directors might give it at a lower rate. In that case also the shareholders must know the company made a profit because the directors have given a loan at a lower rate of interest. If they have gone to the bank and taken the loan would have paid 12% interest, and then the profit would have got converted into a loss. So that is to give some additional disclosure to the people, so they know that because the director's loan is something what can be manipulated. They can manipulate. Now, it can be a director, it can be director's wife or some person like that who is somewhat connected to the company. If they give a loan, it may not be on commercial rate of interest. That is why it must be separately disclosed. They are called related party transactions. Is it clear?
It is.
Yeah.
Yes.
Right. So interest is always paid out of pre-tax profit. I mean, it's an expenditure that is allowed for tax purposes, just like the salaries, just like the electricity, just like the water, just like the telephone, just like the rent. Interest is also a rather expenditure that is charged to the P&L, and therefore it is tax deductible. Whereas the dividend is paid out of profit after tax, and therefore it is not tax deductible. From the company's point of view, debt finance carries a risk. Why? Because if you don't pay the interest on the due date, if you don't pay the capital on repayment on the due date, the lenders can take the company to courts and can demand the interest. If they can't pay, the court may even declare the company bankrupt. But the shareholders, even if they don't get a dividend, they can't go to the courthouse and claim or ask for a right, because that is not allowed. So debt finance carries a risk to the company, and if the capital payments are not made on time. When you take money in form of equity from the shareholders, you don't need to give any security to the shareholders. You just give a share certificate, that's all. You don't need to give any collateral security. But if you go to the bank first thing they will ask is, okay, you want a loan, what kind of security you can give me? So maybe your property has to be mortgaged, your property plant need to be mortgaged, your vehicles need to be mortgaged. So that's what we call a collateral, a kind of a security that need to be given, and that is generally a kind of a thing that need to be given to the bank. But when you go to the market and raise debentures, again, you don't need to give any security. But if you take a bank loan or from a loan from some institution, they might ask security from you. So in the event if you default, the lender will have the right to take possession of the asset with a court order, and they can recover that money. So that's a mortgage. So it's like any one of us. We can mortgage our property and take a loan, and if we don't repay the loan, the bank can just go to courts. Court will order the sale of asset and to repay the loan. So there are two types of charges, two types of security. One is what we call a fixed charge. Fixed charges are generally given for non-current assets like property, plant and equipment. So you can mortgage your property and take a loan. And in the event of something happening, that property which is mortgaged to the bank, bank will have the first priority. They don't need to wait in the queue to get the money in the event of a liquidation. They can sell that asset. Whatever the proceeds from that asset will be for them. If the loan is 100,000, if the building is sold for 125,000, they can't take 125. They will have to give the 25,000 back to the company, but the 100,000 they can recover. But if the loan is 100,000 and if the building is sold for 75,000, they will get the 75. The balance 25,000, no security. They will have to stand in the queue with all the other creditors and get whatever the share they can get. So the people who have got security, they are called secured creditors. Secured creditors. That is, if they have got a mortgage or something like that, they are called secured creditors. They don't need to stand in the queue along with the unsecured creditors. They can sell the asset and collect the money. But if they collect more than what is owed to them, that balance money they must give it back to the company. But if they collect less than what is owed to them, for the balance they can wait in the queue along with all the unsecured creditors and get the whatever the share. So that's what we call a fixed charge. Then we have something called a floating charge. So as I said, the fixed charge is always on non-current assets. It's fixed. Floating charge is not on the non-current assets. Generally, it is on the current assets, like inventory. Now, you know inventory is not something fixed. Today you have some inventory. Tomorrow it will be sold. Something new will come and the figures can change. So maybe you are giving me a loan to my company, $50,000 on a floating charge on the inventory. So the day that the company decides to go for liquidation or the way that you file action, the inventory value of the company may be 15,000. Yesterday, it would have been 40,000. But so it is floating. It is not a fixed amount. It is changing from one day to the other. So whatever the figure that is there, you can claim it. But on a floating chart, there can be many people who will have an interest. Not only you, but there will be many others who are interested on a floating chart. But on a fixed chart, it is what we call a primary mortgage. Only you, the lender, you have a right on that particular property. Not all the other properties. That particular property, it's your right. You have the right to demand to sell that asset and to pay. So what are who are called preferred creditors? Preferred creditors means they are the people who have a preference when it comes for the settlement than the others. So always the secured creditors are the preferred creditors. So the most preferred creditor will be the fixed charge creditor because he has a good preference, and the second preferred creditor will be the floating charge. Others are we call unsecured creditors. They don't have a preference. They must stand in the queue with all the others to collect their money. When you take loans from a bank, just like this picture shows, sometimes your hands are tied. The director's hands are tied. They put lots of conditions saying till you repay the loan, you can't pay a dividend more than say 40 cents per share. Till you repay the loan, you can't increase you can't take any more loans. Till you repay our loan, you can't issue any new shares. Till you repay the loan, you can't increase the director's salary. So these are called covenants, the conditions put forward by the lenders. So shareholders can't put any conditions, but the lenders, particularly the banks, they will put certain conditions what somewhat can be restricting the company from what they want to do. So this is a kind of a way that the lenders try to impose certain restrictions through direct covenants. So that way also their risk is minimized. So one thing, they are protected by the court law. They must get their interest and the capital repayments. If they don't get, they can take the company to courts. Also, they can take security, and if the security, they can sell the security, that particular building, and recover money. Also, in addition to that, they will put certain covenants to ensure that the company will not jump over the boundaries. So sometimes they might say current assets to current liability ratio should be always 2:1 before you declare a dividend. Can put lot of things. So they can put a restriction on the dividends, saying you can't pay more than 20 cents per share. Financial ratios, they might say the current assets to current liabilities should be so much, interest cover should be so much, debt gearing should be so much, can't exceed. So like that they can put up. Then they might say financial report should be prepared according to international accounting standards and must be prepared every 3 months or 6 months, and it must be forwarded to the banker and certified by the auditors, all that kind of a thing. Sometimes they might say you can't issue any further debts till these things are settled. So even though you have some good projects, you can't do it because you have signed a covenant with the bank and the bank is putting restrictions on you. So sometimes you might issue what we call subordinated debt. So the banks can only put up those restrictions for debts which is going to rank equally, what we call pari passu. That is, in the event of a liquidation, if they are standing in the same queue, then the bank can put restrictions. But sometimes there may be, you might take a loan which is not going to be pari passu. In other words, in the event of a liquidation, they are not going to stand in the same queue. They are going to stand last in the queue, and that kind of, if you can get money like that, then of course the banks can't put any restrictions because they will not ask for any money till the banks are fully settled, others are fully settled, and that kind of a creditor, if at all, is called a subordinated debt. So sometimes maybe directors can give some loans to the company and they say it will be subordinated to the bank loans. So in that case, the bank can't put any conditions and restrictions all that because the directors have given a loan, and that loan, they are not going to stand in the same queue and demand. They will ensure all the others are settled, and if there's a balance only, they will last. In that case, the bank's rights are not affected. Then banks can't put any covenant on that. So two types of covenants. One, what we call negative debt covenant. Negative means always don't do that. You can't do. So it specifies various things what the company cannot do. Cannot take any additional loans. Cannot pay any cash dividends exceeding a certain amount. Cannot sell certain assets. So even if you have a big buyer, they will say you can't sell the property. Cannot enter into certain types of leases. You may find that the leasing company is prepared to give you some money to do a business, but they will say sorry. Cannot combine in any way with another firm. You can't merge. If you are merging, they will say first settle our loans. Cannot compensate or increase salaries of certain employees like directors. So that is all to protect the loan or given by the bank. So these are what we call negative covenants. All cannot. And we have the other side, the positive covenants. That is all saying you must do this, you must do that. They will say you must maintain certain financial ratios. Current assets to current liability should be 2:1. You must prepare financial statements in line with IFRS. You must get the accounts audited by reputed auditors and given to the bank within 2 months period. You must regularly maintain all the assets that is there, because sometimes they might have a fixed charge on the asset, but if the company is not going to maintain the asset, the value will drop, and therefore they might say it must be properly maintained. They might ask you to take insurance. They might say all taxes and other statutory liabilities to be paid whenever due, because even though the bank has the priority, even if it's a mortgage, still the taxman has a better priority. So they don't want the taxman to come and take all the money. So they will tell the company, see that you pay taxes and your employee liabilities, etc. on time. What is the impact of a covenant? So, from the lender's point of view, from the bank's point of view, it certainly restricts the activities of the borrower, and they can't just do any risky thing. They can't just pay dividends, that kind of a thing. So it provides some kind of a protection to the lender. What about for the borrower? I was working in a company where that managing director was very, very crazy man. Every time he want to go and take loans. And by taking loans, what he do? He go and buy new cars, all that kind of a thing. So the bank has put up a restriction. The bank has put up a covenant saying that current assets to current liability should be 2:1 and something that they can't increase the fleet of vehicles, something. So I was very happy to work with that covenant, because that was the only way I could keep that man under control. I remind him the covenant and say, bank will not allow you to do this. Otherwise, he will just go and buy a Mercedes-Benz car and something and really go crazy. So, in a way, from the borrower's point of view, that is company's point of view, this kind of a covenant can bring financial discipline. Debt covenants are not intended to put a burden on the borrower. It is just to make the borrower more disciplined, more controlled, so that they will go in the right way. Otherwise, what happens is they will take loans from the bank and they will go and buy all sorts of things, and finally the bank, they can't pay and the companies will collapse. So the banks are not interested in companies getting collapsed. So therefore, the covenants can be a kind of a good discipline in a way. This is very important. Criteria for selecting the type of debt. There are many debts available in the market, or many kinds of loans available in the market. So most of the companies will borrow from the banks, but banks are very restrictive. They will put lot of covenants. They will ask lot of security. The much more easy way to get money, if you are a listed company, is go to the stock exchange and issue bonds or debentures or loan notes. That way, it's not so expensive and you can do it. What you have to consider all the time when you are borrowing is the liquidity, time scale, and cost. I'll start with the last one, the cost. You must always look at what is the interest rate. You want to borrow it at the cheapest rate. That's number one. Second one, time scale. Now, generally we believe in something called a matching concept. What is that? If you are taking long-term assets, you must borrow long-term funds. So if you are going to take asset which is going to be used for 10 years, borrow the loan for 10 years. Because otherwise what happens is, if you take a loan for 2 years, and if the asset is going to generate money over 10 years, you will be in financial crisis. Because that asset is going to take 10 years to generate money, but you have taken a loan which you want to settle it in 2 years' time, you will be in a crisis. Similarly, if you take a loan for 10 years, and if you are going to do a project which is only going to be 2 years, that is also crazy, because next 8 years you may not have a project, but since you have taken a loan for 10 years, you have to pay interest. The project is finishing it up in 2 years. So you have to match the period of the project with the loan. So that's what the time scale means. Finally, liquidity. Liquidity means sometimes in the market, you remember in 2007, 2008, there was what we call the credit crunch. Because of the recession, the banks are not prepared to give money. So maybe you want money, but the banks are not willing to give you money. Maybe not because of your company is bad, but for many other reasons. So that's that kind of a selection you have to look at. Generally, there are many types of borrowings. Number one I want to discuss is what we call money market borrowing. So generally the money market borrowings means short-term borrowings. Generally it is between the banks at the end of the clearing of checks. One bank will borrow money from another bank, and generally because it's banks borrowing, very less default, they charge the interest rates, which is very cheap rate. And in London, when they do that one, that is what we call LIBOR, London Interbank Offer Rate. So every day when the interbanks borrow, that's the rate what we call LIBOR in London Interbank Offer Rate. So generally most of the money market borrowings are short term, and generally it is done by the bankers. However, some big companies can come to the money market. They can borrow just for a few days, or maybe sometimes even they may lend it. They have a lot of money for a short period. Till the next shipment comes, they have money, and they might lend it to the people at short period to the money market borrowing. Capital market borrowing, when you go to the market, stock exchange and borrow money, they are essentially long-term funding. So bonds, equity, loan notes, debentures, they are essentially long-term funding. Money market borrowings are generally short-term funding. So most of the big companies can come and borrow from the money market for short term. So essentially what you need to learn is money market borrowing is short-term funding, capital market borrowing is long-term funding. Revolving credit facility. This is another facility that the banks have. Banks can give it to a company. It's like overdraft. Now if you take overdraft today of 1 lakh, right? Tomorrow if you use 1,000 out of that 1 lakh, you will be charged interest only on the 1,000. Next day you take 10,000, you will be charged interest only on the 11,000. Even though the facility is 1 lakh, you will be charged only on the amount what we have drawn. Third day you pay 5,000 back, you will be charged interest on the 6,000. So similarly, what happens is the big companies can get not an overdraft, what we call a revolving credit facility. It's a facility that is given to you. But you may not use the entire facility today. You might use little bit. So you pay interest only on the amount that you have utilized, that you have paid, not on the entire amount, right? So this way the companies can save lot of interest. But if you take a loan, 5 years, if you are taking a loan today to be repaid in 5 years, whether you spend the money or not, you have to pay interest on the entire 100 million interest from the day one. But if you take a revolving credit facility of 100 million, if you spend only 10 million in the first month, you pay interest only on the 10 million, not on the whole amount. So that's what we call revolving credit facilities. So I'm afraid I have not been able to finish it. I have a little bit more to do, but I want to do this area fairly deep. So we will move on to the next part of this area, but surely next week you can finish it. So Tuesday or Monday is your day.
If it is possible, Monday.
Yeah, Monday I can. Monday I'm all right. So shall we make it Monday?
Monday and Thursday?
Yeah, Monday and Thursday. Sure, no problem.
Okay, perfect.
So it's 7 o'clock on Monday and Thursday 7 o'clock.
Okay, perfect.
Okay, right, okay. Take care. Have a great day.
You too. Bye.
Bye. Bye.